Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on Friday, August 19th. My name is Ian Saunders, and joining us as well today is Will Gibson. So, Will, it's good to have back-to-back weeks here sitting across from each other. And interestingly enough, we're coming in today with some not quite as much movement as we have been the last few times we recorded this podcast. I thought we were just hitting a hot streak there of spikes up or down in market days when we recorded the podcast.
Yeah, it was producing easy stuff to write about in the report and talk about on podcast. Still plenty of things going on in the market. Some I think kind of residual effects that we've seen over the past couple of weeks are probably more noteworthy today, not necessarily what's transpired itself in the past several days.
Yeah, I mean, we had a nice little streak there of updates for the S&P. I mean, 4 consecutive updates for the S&P, and then that streak ended with movement yesterday. We saw the S&P show a little bit of a decline. Or was that earlier this week? I'm getting my days confused.
Right. I think yesterday a little bit. Yeah.
Right. Yeah. So showing a little bit of a decline, but I mean, nonetheless, we've seen a lot of the indicators kind of show some improvement, and we hit on a lot of different indicators on this podcast. Right. We talk a lot about participation stuff. We talk a lot about relative strength changes. Today, we're going to look at an area that we do touch on, but just look at it a little more in depth. It's a page we call the asset class group scores page. So for those who might not be as familiar, it's another kind of relative ranking system that we have on the Dorsey Wright research platform, which is essentially just aggregates different fund scores for different mutual funds and ETFs that we have. That score goes from 0 to 6. 0 is the worst, 6 is the best. So simply what we're doing is taking a classification for ETFs or mutual funds and then just averaging their scores together to get an average score for the group as a whole. So there's 134 different classifications that we look at. So pretty much your whole investable global universe, right? Equities, fixed income, commodities, sectors, sizes, styles. Pretty much, I mean, anything you can think of, or at least anything that we've tried to think of is there on that page. And it tends to be a little bit kind of quicker moving, a little more in tune with your day-to-day, week-to-week movements that are going on in the marketplace. And I know that one of the things that we've been watching pretty closely over the course of the past several months has been kind of 2 broad readings that we have from that ranking. So we have 134 different areas, but 2 groups in particular, your S&P 500 index funds group, what we call the kind of core equity group, and then the money market group, the U.S. money market group is kind of a cash proxy ranking within that scoring system. So we have it's kind of 2 percentile rankings, which is the U.S. equity 4% rank. So simply, how high is that S&P 500 index group scoring? What percentage of names is it beating in that ranking? And then the same thing on the cash side. We call that money market percent rank. What percentage of names is his cash beating within that scoring ranking? And that's kind of used as in a lot of different ways. It's used in some cash triggers that we have in some of the models in the platform, but it's also just helpful in kind of understanding market movement, right? And we've seen some interesting movement from that over the course of the past 2 weeks. I know we touched on some of the research.
Yeah, we touched on the research. I've mentioned it, and I think some of the morning update videos as well, particularly the divergence, I'd say, of the money market rank and the equity core rank. Starting with that equity core, it's up at 97% right now, which translates to it's ranked 5th out of 134-ish groups on the page. Said bluntly, that's a very high reading. It's not something that you typically see advance to that degree. We did put in our report, I believe it was 2 days ago, about historical market behavior when you see an equity core reach the 95th percentile. Longer term, I'd say 6 months to 1 year out, you were generally positive, being returns for the S&P 500 itself were positive. In the near term, though, it did signify some froth and some overextension, some kind of notable pullbacks in that near term. So that's something to watch for. And then just conversationally, Ian, I think we talked about this, or somebody talked about this on a recent call, is that when you have the core equity ranking that high, it makes it pretty difficult for active management, because you're looking for what's beating the market, or how can I find alpha outside of the S&P. And with it ranked 5th out of 134 groups, there's not really as much opportunity to do that right now, at least for the near term, because it's working so well and so robustly. Right now, your only groups scoring above the S&P are consumer staples, which we'll touch on in a little bit, utilities, and then more commodity-focused groups like energy and MLPs. And both of those have negative score directions right now. So those are weakening. So it's a tough place to be in one respect, probably a better place to be than the other side of the spectrum for intermediate to the long term.
Yeah, and I mean, like you kind of touched on, it does. I mean, like there's not that much beating the S&P, so it's kind of harder to kind of outperform, right? But it's also there's just it kind of that froth environment too. I mean, we've seen other times that this percentile rating has been 100% before, right? In July of 2021, I mean, up at 100%. It's been at 99% like December of 2019. I mean, it's been up there. It's been higher than 97, but 97 is pretty high. I mean, interesting. We've been looking at some of the testing, it's north of 40% of the time it's spent north of 80%. So throughout the history of the S&P 500 percentile rank, it's been north of 80%, about 40% of the time. So it's good to have it be higher in the rankings. But that's kind of 70 to 80, 80 to 90 zone is where there are areas that are beating the market. There's ways we can generate alpha, right? There are places that you can go into, you can try to outperform. And when you see it get this high, it's that kind of froth that might be getting a little bit too high. I mean, you'd like to see it kind of back off a little bit, but nonetheless, high is good for this reading. I think is an important thing to note.
Yeah, I mean, much better than the opposite. Like you would rather have it in the 97th percentile versus the 3rd percentile at the bottom of all groups. And then if you look at the money market side of the coin, so not so much what your equity core is doing, but how is your, we'll call it riskless benchmark cash ranking, that's just below, that moved into the bottom quartile of all groups, which that's moving in a good direction, telling us that more groups are functioning better than cash at this time. It gives you more opportunity, I would say, or areas that are beating cash. A lot of fixed income areas have moved over cash recently. You saw on exhale and rates, that's been a nice tailwind for some of those areas beneath cash right now. So what is cash still functioning better? There's some currency pockets. There's some, actually fair amount of fixed income still down there. Inverse market quickly made its way to the bottom of the list. That was at the top for a while. You have Europe, China's back down there, some other Asia developed markets as well. So kind of a hodgepodge beneath money market, but it's a good benchmark to keep an eye on.
Yeah. And I think another thing to note, I mean, that money market percent rank, I mean, it got north of 70%. The U.S. equity core got pretty close to 70%, but they never crossed in this recent kind of environment, which in other really kind of deep declines and bear market environments that we've seen, I mean, then a lot of times you see them cross.
Yeah.
And so that's, I mean, it didn't cross in 2020. That was such a quick, I mean, literally a V and then an upside down V that you can see on those graphing, on those charts. They're pretty descriptive there. But you saw it in the 2007 to 2009 environment. You saw it again in the late 2010 environment. You saw it again in the 2011 environment. You saw it cross in the 2016 environment. You saw it cross in the 2018 environment. And you didn't see it cross this time, which is kind of an interesting thing to note. I mean, that we saw the S&P 500 rank, I mean, did hold up better than a lot of areas, a lot of other equity areas, and that the money market rank was beating a lot of areas, but didn't climb north of that S&P 500 rank.
Yeah, that's an interesting note. I hadn't noticed that for this time for sure. Something that we do look at, though, there are some kind of three key thresholds when those do cross. We're looking at if cash is going over 50% of groups, and then if that equity core goes below that 40%, that's a key kind of cash raising indicator that we have. It's definitely seemed like cash has been more easily able to climb over 50%, or that will be typically quicker to go than your equities really driving down to below 40%.
Yeah, we haven't had the equities drop below 40% since 2011 in those rankings. I mean, it's been over a decade now of that equities position scoring in the top 50% of the rankings at all times, which is a pretty interesting thing to note. But I mean, that's not to say, so now we have the equity core percent rank. It's high. It might be a little bit frothy. We've seen some other kind of potentially overextended indicators from some areas, but kind of it is good to see it high. And it's good to see the money market percent rank low. 25% is still not nearly as low as we've seen. I mean, you've seen, it's really good to see this thing down below 10%, right? So lower beneath 20 is good. Beneath 10 is better. I mean, it's been pretty close to zero over the course of the past several years at some points. But at least it's moving in the right direction, right? Now there is some other interesting movement we've seen from some of the places underneath the hood, right? I mean, I know we were talking before hopping on here. You touched on some of the areas that are still kind of beating the S&P 500 index funds area, and one of those the consumer staples group, right?
Yeah, a bit of a head scratcher. I mean, you're seeing more of a risk on tilt from a lot of markets, a lot of asset classes, and then you look at the group rankings, and consumer staples and utilities are still ranking above the market, which is maybe an interesting note in and of itself. But a note on staples, I was looking at this yesterday on our rundown call, its relation with consumer discretionary. So consumer staples being your more traditionally defensive sector, areas that consumers will spend their money kind of regardless of economic environment. You're thinking food, you're thinking household necessary products. Discretionary on the other hand being much more leisure spending. So looking at the tracking of those two groups over time, there's been some really timely crosses between these groups. So you would think when markets are doing well or it's becoming a more risk-on environment, your non-discretionary group is going to weaken in technical score, and then your discretionary group is going to rise in technical score. And there's been some timely flips, like I said, most recently, and I'll throw this on YouTube if you're watching there, we saw a flip of these two groups in December of 2021, where staples or non-discretionary, non-cyclical, all synonyms here, overtook consumer cyclicals in December of 21. That was a really interesting cross. Of course, we have the hindsight to know what happened later. Prior to that, a couple instances, you saw staples move above discretionary in February of 2020, early March of 2020, and then they unwound themselves in April of 2020. Another pretty key environment you saw this happen, October of 2018, staples moved above discretionary, and then they unwound themselves at the end of December of 2018. So all of those, I think, or at least those three instances in the past 5 years have been pretty notable crosses. But today, they're not really close to crossing. Like staples is moving up.
They're moving in the opposite directions.
I mean, to some extent, discretionary is still moving up. Right. But as you can see, this recent divergence is really still diverging. It's not converging. You're not seeing staples weaken in technical score and dip below the discretionary group, which is really coincided with a lot of the previous big market recovery. So we've talked a lot about great participation, breadth thrusts. If I were to point to one thing and be like, this doesn't sit right with the rest, it would probably be this.
Right. And I mean, I think you've seen them kind of diverge. And I mean, a lot of times recently you've seen cyclicals beating the non-cyclical space. I mean, but you look back in that 2016 environment, right? I mean, that early 2016 when they diverged, you saw a pretty solid period of time, almost a year there, that or not quite a year, but 9 months where non-cyclicals outscored the cyclical space. And then they switched and cyclicals outscored for 2 years. I mean, it's definitely, you definitely see some pretty notable divergences, and it certainly seems like we're continuing that divergence, which is maybe not something, it's a little bit surprising to see.
It is surprising. Definitely seeing the historical precedent when you see the groups cross typically have been around pivotal market environments, kind of changing direction structurally. The 2015-16 note, I'm kind of glad you brought that up. That's a really odd, not so much odd, but an eerily similar environment in some ways to what we've seen.
Yeah, we were talking about that with some other indications. Some of those dates keep kind of popping up, which is, it's easy to look at 2007 to 2008-9 environment, but 2015, 2016 too. I mean, some of those dates pop up. It's not you shouldn't always kind of look past that.
Yeah, it's not as often as much of a talking point as 2008, of course, but that's the one, and at least note in our data points, we've seen a lot of market similarities between those years. So see if it kind of plays out the same. Certainly could.
Yeah. I mean, that's every market environment is going to be different. We say that every time, right? But I mean, you've seen some other kind of similarities through some other areas, especially there on the group scores page. I mean, in another relationship that I've been kind of monitoring is the movement in technology, right? Movement in technology group score movement was very low, historically low from that we've seen over the past. I mean, the internet group hit its lowest score ever on the ranking in this recent decline.
Wonderful.
Technology hit its lowest score in well over a decade. I mean, it's very, very kind of unique movement for that space. But I'm looking at that group movement relative to money market is another kind of interesting relationship. So you're looking at the cash proxy. I mean, technology is now back above the money market group score. But a lot of times in some of at least the more recent three kind of 10%, at least 10% declines or heading towards bear market environments, that you've seen the technology group move lower, right? When it's kind of touched the US money market group score, market rebounds and goes higher. Did not happen this time, obviously. The scores crossed in February and then continued to show a little bit of a pickup from the technology group, get kind of close to touching again in late March. We got that rally at the end of Q1, and then they headed right back down, and technology group made multi-year lows from a score perspective. Money market continued to tick up, and then they've now crossed again in August. So money market is now below, technology is rallying back, kind of heading towards that 3-score line, which is in the more recent decade. Once it gets back above that 3-score line after moving below, it tends to be a pretty good environment, but it hasn't dropped below the 2-score line in well over a decade prior to this most recent movement. You got to go back 2008 to see the last time the technology group was scoring below the 2-score line. So it's a lot of kind of interesting similarities that we can see from some of these areas and other market environments, but also some notable differences.
Definitely. And with the tech thing, I think this is, again, kind of has to be an important sector to watch because it's such a big weight in the market and has been increasingly a bigger weight in the market over the years. So to see the market do well, you're probably going to need to see tech do somewhat well,
right?
At least your cap weighted market indices. So like you said, nice to see this working towards that 3 threshold, crossing above money market. You don't see a lot of kind of double dips like what we were talking before, where you break below 3 or break below 2, go up, go back below 2. There's just not a lot of precedent for that. Maybe it's because you've been in a multi-year decade of kind of bull market environment for tech. But so kind of making some new chart action here that we haven't seen before.
Yeah, well, I mean, we haven't quite seen that action. Scoring this low and then going back above money market is a good sign. We did see, I guess you could call it a double tap back in again, going back to 2008, 2009 environment, was the last time that we saw this kind of very notable divergence and money market scoring higher, tech scoring lower. They crossed and then they uncrossed briefly, and then obviously fell out of bed and got down to the March 2009 lows before kind of rallying back higher. So I think that was the one kind of the line in the sand that we have seen cross, uncross, and then cross again. But other than that, and like you said, we haven't seen technology rebound from such a low field position without kind of maintaining its distance above money market, which will be an interesting point to monitor for sure moving forward.
Definitely. Yeah. So if I were to kind of summarize today, I'd say several groups to keep your eye on. Equity core, as we led with, money market second from a macro perspective to see how those are functioning. And then beneath the surface, I would throw out that consumer discretionary and staples relationship, maybe see if we can get those to converge a little bit here. And then like Ian said, I think tech is inevitably going to be an important sector to keep an eye on, and its relationship with cash, given what we've seen historically before. Not to say that's going to happen again, but this quote goes around the technical analysis community all the time. I feel like it's that history doesn't repeat, but it often rhymes, and probably goes around because there's some decent truth to it.
Yeah, absolutely. Great. I mean, we could keep sitting here talking about the rest of the 130 different groups on the group scores page, but
let's do it.
I don't know if I don't know if the listeners are going to have time for that, but hey, that gives us the next 130 podcasts to talk about, right?
Yeah.
But yeah, I guess with that, I mean, I think that wraps up most of what we were looking to cover here this week. Thank you all for listening here. Will, thanks for hopping in and let me join you again as well. Always great to do this in person. Thank you everyone for listening. We'll look forward to talking to you again next week.